Hey, welcome to the podcast. I have Hawaii's economist, or I'm calling him Hawaii's economist, Mr. Paul Brewbaker, who has been the chief economist or associated with the Bank of Hawaii as the chief economist for the past 25 years or so. He's a
Well,
Stanford alum. He's a UH PhD, and once again, I'm branding him as Hawaii's economist. Welcome to the podcast. How's it going?
the last man standing. Thanks, Nicholas.
Okay, right on. So, yeah, one word, GameStop. What are your thoughts on GameStop?
Yeah, how bubblicious was that, huh? And it
Yeah.
went by really fast, I have to say.
Mm.
And maybe it's not over.
Yeah, the whole squeeze and all that. But yeah, what were your initial thoughts as an economist on how that bubble slash squeeze, which still continues, is actually going?
Well, of course, I heard about it too late to get on the bubble. Um, and it did go by very fast. Although I have to say, if you're just, looking at, there's actually a famous book by uh, Herbert Flood, I think, or Flood something and something. Famous First Bubbles is the name of the book.
Mhm.
And it documents, and that's the irony in the title, is that everybody thinks when they run into a bubble that it's the first bubble. And of course, we can document them well back to, I think it's 1638 with tulips in Holland and even before
Yeah.
that. Um, but it happened, the most intense period for the GameStop bubble was about the last month.
Mhm.
But there are intraday, you can see these kinds of events. Um, and I can't remember. There's another famous book. These are econ, nerd books
Mhm.
on bubbles, sunspots, and something else. But so there, asset, what are called asset pricing bubbles
Mhm.
are a familiar phenomenon in economics. People have studied them for a while. There are different ways to think of how, suddenly the value of an asset can, which under circumstances about which most people are aware, suddenly changes in value
Mhm.
and, and then goes back. And we could, now that we're talking about it, I wish I had made up some slides to share and to show you some of
Yeah,
the bubbles that are out there. In fact, maybe Nicholas, if you want to edit that in,
I
you can cut
will.
this part out. I will
Uh,
go put together a short sequence
uh,
that we can look at together, and we'll talk about each of those. But they can happen intraday. They can happen over the Shanghai. We can go get the data on the Shanghai Composite Index, which is sort of like the Nasdaq or the S&P 500 in the United States, which peaked in about, I want to say July. I'm going to get it wrong. Either I think it's June 2015 or maybe it's June 2014.
mm,
But it increased two and a half fold between June 2014 and June 2015. So,
mm.
I mean, not just one stock now, the entire stock market in China increased by 2.5x.
Wow.
And then the bubble burst. And in its descent over the next 6 months, swept up like a flash flood,
Mhm.
swept up all of the world's equity markets with it, caused the U.S. stock market to break momentarily in August, and 2 months after the peak, and then again, notably in January 2016, there's a little kind of implosion in U.S. equity valuations that if you it's that's hard to understand unless you go back and think about the context of this bubble bursting 6 months earlier
Mhm.
and the cascading consequences of that subsequently. And so that's kind of this week for GameStop, right? Because
Yeah.
GameStop opened the month at $15 or $20 a share, and then uh, was appreciating relatively rapidly on a daily basis until I want to say 2 weeks ago, maybe,
Mhm.
January 20th or something like that. And so 3 weeks into, Martin Luther King Day, it was still looking like, oh, that's kind of interesting and kind of pricey, but kind of interesting. And then, of course, it went to $300 plus
Just
a share.
straight vertical. Yeah.
And that's the classic, inflection, as is a popular way to describe it, but an acceleration in the rate of appreciation to a point where it starts to lose the oxygen, right? It gets out into the stratosphere or wherever you run out of oxygen, about 15,000 feet, and then boom, free fall.
Yeah.
So unlike the initial acceleration, there's been kind of a break. In fact, I haven't actually looked at it today, but we're now talking, 4 days later?
It's dipping double digits.
Fast.
Yeah, it's dipping double digits. So there's a lot of bag holders out there who are probably retail traders, most likely Robinhood traders, or people on the up and coming platforms to trade.
But remember that most of those, or many, had a different motivation for the customary retail or wholesale equity investor, right? They're people. The people who are most active in these markets customarily are people who manage large, right? They manage other people's funds, right? Most people invest through mutual funds. They don't actually invest in individual stocks. In fact, we sort of teach in financial literacy and in financial economics courses that you're unlikely to beat the market as an individual. You're unlikely to have enough information to beat the market systematically, to sort of get away with it all the time by investing in individual stocks about which you know something and nobody else does. And by the way, when you do actually know something that nobody else does, that's called insider trading, and it's illegal. Like we have a whole system, legal system, set up to govern trading so that people can't exploit private information in order for the markets not to be unduly influenced by people seeking to monopolize the potential, right? You can think of it, we're talking about time, and we set the game up so that if you have private information about something being worth more or less in the future, you can't monopolize the change in the value that unfolds as a consequence of what you already know and other people don't. If you simply have a belief based on a shared information set that it is going to be worth more or less, then that makes you a speculator, which is fine. There's nothing wrong with speculation. If that's, your money and, your bet, knock yourself out. But of course, as I mentioned, the bulk of funds trading in a typical trading day are being managed in the aggregate by professional fund managers, and most people put their money in broad-based diversified funds that many of which have a different sort of philosophy or tilt or algorithm that their investors and the managers think might give them an advantageous position or take advantage of some mathematics that we only recently developed, and so on.